From a fundamental point of view, I'm on the bullish side, and you never exactly know what these central banks are going to do, but the trend is your friend, and the trend right now is a lot of central bank buying. Even if gold stays the same throughout the year, it's at the same price at the end of the year as the start of the year. It fluctuates around, and to pick up that fluctuation and trade on it, Abe Kaufness and I have developed something we call the Hanke Kaufness Gold Sentiment Score. Now, how many central banks are buying silver? I mean, I don't know if any of them are, quite frankly.
The past week marked a notable upswing in silver prices as XAG USD surpassed the critical 23.75 threshold, achieving its second consecutive week of gain. This surge was primarily attributed to a decline in the US dollar, prompted by market conjecture suggesting a potential halt in interest rate hikes by the US Federal Reserve. Nevertheless, the subdued trading volume post-holiday may have accentuated this unanticipated price movement. Speculations on interest rates and trends in Treasury yields. U.S. Treasury yields saw an increase last week, with the benchmark 10-year yield rising by over 5 basis points on Friday. Despite the recent Federal Reserve meeting minutes not indicating an imminent rate cut, market sentiment leans heavily towards maintaining the current rate in the upcoming December meeting. Future trends in the silver market. The trajectory of the silver market in the approaching week is likely to be contingent on evaluations of interest rate developments and key economic indicators. Decisions made by the Federal Reserve, fluctuations in the US dollar, and trends in Treasury yields will play a pivotal role in determining silver prices. While potential medium-term rate reductions create a favorable backdrop for silver, immediate price trends may be tempered by ongoing economic analysis. Impact of Fed speeches and economic data on silver. The upcoming week will center on speeches from members of the Federal Open Market Committee, FOMC, expected to provide insights into the Fed's stance on interest rates. Any indications of a dovish approach or potential rate cuts could strengthen silver prices by weakening the U.S. dollar. Furthermore, releases of economic data, including GDP, personal inflation, and ISM manufacturing PMI, will offer insights into the overall health of the economy. Strong data might support arguments for rate hikes, applying downward pressure on silver, while weaker than expected data could advocate for rate cuts, supporting the bullish trajectory of silver. In summary, the recent surge in silver prices is a response to a softer dollar and speculation about Fed rate hikes. However, the future direction of silver hinges on the actions of the Federal Reserve, movements in Treasury yields, economic data, and the commentary of Fed officials. Investors should closely monitor these factors to assess whether the upward trend in silver will be sustained or face challenges. Like, subscribe, and turn on notifications to get more videos of great financial experts like Steve Hanke, and make sure to take advantage of our partnership deals. Links in the description to get the best crypto sign-up bonuses to diversify your commodities portfolio. Let's get into the video.
From a fundamental point of view, I'm on the bullish side, and you never exactly know what these central banks are going to do, but the trend is your friend, and the trend right now is a lot of central bank buying. The reason behind that, I think, is that there's just simply a lot of uncertainty. Everything has become more and more politicized in the realm of fiat money, shall we say, and as a result of that, the central banks are accumulating gold. They've been not big players in the market for some time, but now they are. Particularly the ones that are in this kind of de-dollarization mode. They want to lighten up on their dollar exposure because the U.S. has so politicized and weaponized the U.S. dollar with particularly sanctions. I mean, since 9/11 and the war on terrorism has started, sanctions have just gone up, and now with Biden, on steroids. They were going up very fast with Trump, by the way. So it's kind of a bipartisan thing. It doesn't have anything to do with political parties. It's just, I think it's utter stupidity on the part of the United States, but that's a reality. So you've got China buying big, even Poland. Poland was a big buyer in the last quarter, and the Polish officials, you know, essentially said just what I was saying. So that's the fundamentals. Now, on the short term aspect of gold, for me, of course, I'm long. That's as an investment. But now let's look at trading, because even if gold stays the same throughout the year, it's at the same price at the end of the year as the start of the year. It fluctuates around, and to pick up that fluctuation and trade on it, Abe Kaufness and I have developed something we call the Hanke-Kaufness Gold Sentiment Score.
Now, Steve Hanke explains how the sentiment score he developed works.
And what we do every hour, we do text mining of all the articles on gold that come out. And that text mining that's done by computers determines, given a dictionary of words that we've developed, whether the article is bullish or bearish on gold. And if it's bullish, we get a high positive score. These scores go from plus 10 from the bullish side to minus 10 on the bearish side. So how do you trade on that? Well, you have to develop algorithms that are connected to the sentiment score for trading purposes. And if the sentiment score goes way positive, let's say it's plus 4, 5, 6, that's bullish. What you want to do is either liquidate your long position in your trade or take on a short position, because we know that with a high probability of over 60%, that sentiment score will revert back towards neutral or bearish. It swings back and forth, back and forth. So you can be putting on, maybe even 3 trades a day. Maybe you're long, then short, then long again. And we've been doing this for a couple of years, and the performance has been quite good, in like the 30 to 40% return per annum, depending on the algorithm. It depends on the algorithm you have set up and connected to the sentiment score. So that's it on gold.
On Monday, gold prices reached a 6-month high, buoyed by a weaker U.S. dollar and the perception that the U.S. Federal Reserve has concluded its interest rate hike cycle. Spot gold saw a 0.4% increase to $2,009.69 per ounce, and U.S. gold futures rose 0.3% to $2,009.50. Analyst Kyle Rodda from Capital.com attributed the movement in gold to the decline in the U.S. dollar, influenced by recent soft economic data. The market's attention now shifts to upcoming U.S. inflation data scheduled for later in the week. Gold initially surged during the session, reaching as high as $2,017.82 per ounce. But this might have been characteristic of a thinner Asian market, according to Rodda. The dollar index, down 0.1% against its counterparts, remained close to a more than 2-month low reached the previous week, making gold more affordable for holders of other currencies. Investors are now waiting for the Rivershed U.S. third quarter GDP figures on Wednesday and the U.S. PCE price index, the Federal Reserve's preferred inflation gauge, on Thursday. Earlier in the month, a lower than expected consumer inflation print raised hopes that the Fed could potentially initiate monetary easing sooner than anticipated. Traders widely anticipate the Fed to maintain rates in December, with around a 60% probability of a rate cut in May next year, according to CME's FedWatch tool. In other developments, Japan's October services PPI rose to 2.3%, up from a revised 2% in September, contributing to the belief that the Bank of Japan might terminate negative rates in 2024. Spot silver observed a 1.3% gain, reaching $24.61 per ounce, while platinum experienced a 0.3% decline to $927.48. Palladium rose by 0.1% to $1,069.85 per ounce. Make sure to like, subscribe, and turn on notifications to let us know that you like the video.
It's an industrial component, as you know, but it also has a big financial store of value component. This huge central bank buying. I mean, how many central banks are buying silver? I mean, I don't know if any of them are, quite frankly, but uh, I don't have anything really very constructive to say. I mean, you just enunciated what one analyst has put forward, and that is bullish. But remember, the market price of something is an objective value. All these individual analyst reports, that's a subjective analysis of what some analyst thinks. And then you and I and thousands of other people take in all those subjective things, and we decide, oh, is the market price that's objective, is that above the subjective level or below? And if the market price is below where we think the subjective level is, we buy. And if it's above, we sell. So it's a, you've got one analyst, and that's what they're saying, and if we looked at all the reports, added, aggregated them, made them comparable and everything, we would come up with a subjective idea about what we thought the fair value subjectively for silver was. Precisely about this industrial policy, they call it, and industrial policy is where you have the government picking winners and protecting losers with subsidies and that kind of thing. So the U.S. has not really practiced open industrial policy, and now with the Biden administration, they've adopted explicitly, as of April, a speech that the National Security Advisor Jake Sullivan gave at the Brookings Institution. You can Google and find the thing easily. That lays out a new economic model for the United States, which is an industrial policy model. So that means what? The U.S. is going to copy what they're doing in Europe. I mean, and of all things, I mean, the French are even bitching about this industrial policy thing that the Biden administration is adopted. They say it's kind of over the top. So the U.S. I anticipate is going to be in for economic trouble in the long run. This outsized increase in productivity and GDP that I've said over the last 50 years in the United States, that gap is going to narrow because the U.S. looks like it's moving in a position to kind of copy Europe, have more of a European kind of model. And this, I think, is going to end up being a disaster. It follows, by the way, logically, because U.S. sanctions are what? Sanctions mean that the government and politicians are getting in between a willing buyer and a willing seller. Well, that's sanctions. Now, what's protectionism? Protectionism is also the same thing, getting in the way politically of willing buyers and sellers. Now, if you accept that and you're comfortable with it, which the U.S. population seems to be with sanctions, because both political parties are all behind this. And Trump, by the way, who was a Republican president, he was very big on sanctions and protectionism. And now Biden is very big on sanctions. He's very big on protectionism. And he's adopted this overall industrial.
What do you think of today's show? Do you agree with Hanke? Is it possible for central banks to start buying silver? Post in the comments section down below your gold and silver prediction for 2024 and share this video with someone who's a millionaire. Thank you for watching the video till the end, and I see you next time.